start and kick things off, I think the meat of the conversation is going to be picking these guys' brains about predictions in the future and kind of pros and cons of the real estate market going forward if you're looking to buy. Um, what we'll cover today are current market conditions and the key factors that we've all kind of looked at, indicators, data, stats. I'm sure everybody else here has felt those in terms of interest rates, the stock market, inflation. Those are kind of the key ones. We'll look at what typically happens to housing during recessions, and then what I am really looking forward to, predictions for the housing market. I don't know, Josh, if you want to start off with an intro, and then we'll move to Michael and Aaron.
Yeah, absolutely. So my name is Joshua Sun. With Blue Financial Group, that was a mortgage broker, and I've been doing this for over 17 years. Was also an econ major from Duke, so just really enjoy learning about the markets, and more importantly, using that to help our agent partners and clients, to help them just so you guys know what's going on, help you guys make better decisions. And apologize, I have a 4-year-old daughter here. You'll kind of see her in the background, but yeah, nice. Thank you for letting me be here.
Yeah, thanks, Josh.
Hey everyone, I'm Michael Bellings. I'm one half of the Bellings Brothers real estate team at Compass here in San Francisco. Aaron and I were third generation realtors. She's stealing the show. We're third generation realtors. We're actually born and raised in San Francisco, so we're natives here. Not many of us left. And we're the number one buyer team in San Francisco. I think the last 5 years. We've run our team for 9-ish years now. And yeah, take it away, Aaron.
Aaron Bellings, the older half of the Bellings Brothers real estate team. Like Michael said, born and raised here, love what we do. We were the number 2 team in San Francisco last year, number 1 buyers team. So we know our stuff here in the city, and excited to impart some knowledge on everybody here. Answer all those burning questions about what's coming next. Although our crystal balls are a little fuzzy, we'll do our best job we can.
And yeah, just for context too, Niles, my co-founder here at Nestment, actually used the Bellings Brothers to co-buy a multifamily home here in San Francisco. And Josh has been helping pre-approve some of our co-buy teams or co-buy groups that are already in the process of looking to co-buy, from upstate New York to Joshua Tree to Tahoe right now. So yeah, I went over these kind of like big factors that I think a lot of people are not only thinking about, but feeling. I know that when I go grocery shopping every single week now, the past 3 months, I've definitely noticed, my bills or that total adding up way more than it did prior to the beginning of the year. Also noticed my stock market portfolio taking a massive hit. And then rising interest rates. If you guys are buyers and have been looking at interest rates, you'll notice that they've gone up. So these are kind of the key factors that we're analyzing when we talk about predictions for the future and pros and cons of buying right now. I think historically it's good to note that the interest rates have been low over the past decade and kept money pretty cheap and plentiful, which is why we see a lot of inflation going on right now, and putting a lot of money into the market. So recessions are just kind of one of those things that adjust from having cheap money and a lot of money in the market. Josh, I'm hoping that you can kind of cover the next 2 slides in terms of looking at the stock market and what has happened in the past with recessions and how that relates to the housing markets and maybe what we can expect this time around.
Absolutely. So this is a thing that I looked into myself and I was surprised. So it's always fun to share this. I purchased a house last year, and I was kind of timing the market, trying to time the market, because my natural thought is like everything's cyclical, prices go up, prices go down. So I was waiting to buy, and obviously it didn't work out that well. I'm still glad I purchased last year, But so what I did was I kind of took a look at the stock market, cycles, ups and downs. And if you see this chart here, there's just really big ups and downs. So if you kind of time stocks, it kind of makes sense. But then if we go to the next slide, this is the home price index for the country. Case-Shiller is known as the gold standard of home price index. And this chart goes back to the 1960s, and especially the dark columns are the recession periods. So you see that with the exception of 2008, like right here, where it was because of the bad loans, no verification loans that we don't do anymore. Besides that big dip, kind of through every other recession, home prices either go maintain or they actually go up, and the reason is because interest rates usually fall drastically during every recession, so the demand is really high. So, and as also you can see, like, if you're trying, in the last like 60 years or so, if you're trying to kind of time the market for a big dip, you really don't see one. Besides, again, the '08 crash, which is an anomaly, I would say. Of course, certain pockets in certain areas you may see prices dip here and there, but I would just say overall as a country, that's what I saw, and that's what was kind of surprising to me. So, as we're now likely headed into another recession, the question is like, hey, do I wait? What are prices going to do? Rates are forecasted by some of the top analysts, like David Luna, for example, to drop to low threes, high twos next year. So if that happens, there's going to be another huge spike in demand. So I feel like prices will continue to be strong through recessions.
Yeah, and also one of the main reasons why we even talk about the stock market and how it's relating to the housing market is the majority of people's down payments are in usually the stock market and or cash. But when you get up to those higher price points, it's usually going to be stock driven. So like here in San Francisco, for example, the interest rates affected our buyer pool here, but I don't think the interest rates has affected it as much as the stock market did, because we saw a lot of people's down payments evaporate. Even though the rates went up, if your down payment goes down, then it's a double whammy. So we'll touch on all of this and what we see happening here.
Yeah, that's a really good point. And then, Josh, you also mentioned interest rates. Take us through kind of historical interest rates and kind of what we're seeing now. I'd mentioned in the earlier part of the presentation, interest rates have been really low for quite a while. The past decade, historical like lows in interest rates. So a lot of money driving inflation. Maybe you can talk a little bit more about the recent rise in interest rates that we've seen in the past 4 months.
Yeah, absolutely. So, I mean, rates, even though they're a little bit higher, they're around mid fives, historically, they're super low. If you look at this chart, kind of historically where rates have been back in the 80s, you guys may be a little bit too young to remember that, but they were as high as like 18%. So right now, even 5.5% rates are still historically low. But more importantly, every recession, like I mentioned, that rates have dropped significantly. I wish I had a chart for that, but you guys can message me. I have a lot of other data I could share with you guys later, but they are forecasted to drop to low 3%, high 2%, just because of how like an economic cycle works. And the number one driver of interest rates is inflation. The reason for that is inflation erodes your rate of return. So, for example, if you're an investor lending out money at 5%, if inflation's at 5%, you get a net zero return, if that makes sense. So if inflation goes up to 7%, now you have to increase the rate to offset that inflation. So that's always going to be the biggest driver, more than anything else. So in recession, what typically happens is economic activity goes down, companies lay people off. Combine that with inflation, you were spending more on gas, groceries, rent, stuff like that. Plus the Fed rate hikes makes debt more expensive to service. So all of that, really what that does is takes away disposable income. So now there's just less demand for goods and services, and that's what brings down inflation, and that's what brings down interest rates. So hopefully that makes sense, and that's not too much info, but that's kind of why rates tend to drop a lot during recessions.
And Josh,
also, I think it's important too that people think you're going to have this loan for 30 years. You're most likely not. It's amortized over 30 years, and depending on your generation, of course, but that's why a lot of my lenders like Josh and people recommending 7-1 adjustable rate mortgages, 10-1 adjustable rate mortgages.
Yeah.
And then if we do go into a recession like Josh was talking about, and historically the rates come down, then you can refinance at that point.
Right.
First loan I ever have, I got a really cheap loan, and then 2 years later, it went even cheaper, and I refinanced. So you're not going to have this loan for 30 years, most likely.
100% agree. Yeah. Right now, we're always recommending the ARMs right now because of that.
Yeah. Sorry, I didn't mean to interrupt, Aaron, if you wanted to say something.
You're good.
Got you. Yeah, and then I think another big thing that we've heard or seen a lot of headlines about is just the supply of new houses versus the demand.
Yeah.
And if that's gonna change or if that's gonna continue to kind of drag on for a while, um, and what does that mean for buyers?
Yeah, well, the new construction piece. So part of why we wanted to talk about the new construction piece is everyone thinks that the sky is falling and everything's changing and the market's shifting, all this kind of stuff. Real estate is still garnered by the same factors that all other goods and services are, and that's supply and demand. And we are adding more people to the United States. The Gen Zers are now coming. I'm sorry, Gen Zers are now coming up, and they're the ones that are going to be buying homes now. And we're just not building fast enough because we have all these builders that are hesitant to build because the supply chain costs have gone like absolutely crazy. So they've really started to slow down the construction starts. And when you see about talking to going into a recession, things like that, and I'm kind of jumping around a little bit here, but you talk about going into a recession, then they start slowing down building even further. And then that decreases the supply. And then when you have more people that are wanting to buy, but you don't have enough new homes for those people, that's how you start getting the market start coming back again. So it's like, it's always going to be this parity because when things aren't good, people aren't wanting to spend money to build new houses, but then you're really building for 10 years down the road. You're not building for tomorrow.
Yeah. And
Yeah.
just going off what Aaron said, we've been underbuilding for decades. So you really have to go back to past decades to realize that even we're way behind, even looking at the past.
Exactly. And part of this too is that government regulations make affordable houses just as expensive to build as luxury housing. So you have all these builders that aren't incentivized to build these starter homes for people that, $400,000 to $600,000 homes because they cost the same as building those $1 million to $2 million homes. So who's going to build a $600,000 home when you could spend the same amount building $1 million home? So that further compounds the issue and helps keep prices higher because you just don't have that supply to match the demand.
Yeah, and can I just add, Freddie Mac did a study like a month or two ago. They found that the U.S. is short 3.8 million homes for the supply and demand. So not only is there a big shortage now, like Aaron and Michael were saying, from years of underbuilding, but even moving forward demographically, we are having the largest groups of millennials, people who are in the 30 to 33-year-old home buying age, come through in the next 4 to 5 years. Each year, I think there's about 4.8 million that are going to be coming through. So even moving forward, it's still hard to build because of still supply chain issues, costs, like they mentioned, but also on the demand side, just a ton of first-time home buyers at that age. So it's going to continue. It's going to take a while for this gap to be bridged.
It frankly will never be bridged, and that's part of why it's always a good time to be buying a home. Is that there's just a constant supply strain from the beginning of time. There's been a supply strain. So that's not changing as a result of a shifting market.
Yeah, I think that's a big takeaway from, or kind of like distilling down that analysis of what the supply and demand means for somebody who's looking to buy either for their first time right now or their second time. I think that's a key takeaway for sure. And then just quickly, we can talk about just the fact that more and more people are renting.
Mm-hmm.
This is pretty crazy. Josh, maybe you can give us a little bit of an analysis of what that means to you and how that relates to the housing market at large.
Yeah, sure. This is a chart of vacancy rates of rental properties. So compared to the crash, because a lot of times the question is like, are we in another housing bubble? Is the same thing going to happen? So back then, the vacancy rates were like 10 to 11%. Right now, they're below 6%. And also, besides that, just vacancy rate overall is at an all-time low at 0.8%. And again, that just goes back to the growth in population combined with the underbuilding, of homes in supply. So what that means is rents have skyrocketed. You guys probably all know that, right? In the top, metro areas in the country, rents have gone up about 30% or more. And rents are going to continue to be high. And what that means for the housing market is that's going to just support the prices of the homes, because if people are paying $3,000 to rent and they could buy for like $4,000 and get the tax write-offs and invest in in equity and have their own space and backyard and whatnot, it's just going to make buying more attractive. So just for those reasons, that's another factor to consider.
And what's interesting too in this graph, you can see And this is Josh's graph, but I believe the shaded parts are times of recession, if I'm not mistaken. Same on the previous graph as well. But you can see in 2008, the vacancy rate went up slightly, which I thought was really interesting because the most recent mini recession pre-COVID, the vacancy rate just plummeted because everybody moved out wanting to go into their own spaces. And that's what really helped boost rental prices because you had these 3 bedrooms with 3 different couples in it. And now those 3 couples moved into 3 different homes. Again, further compounding the supply issue. It's all about supply and demand at the end of the day.
Yeah, Aaron and I are personally looking for investments and closed on one last year because when you look at some of the multi-unit opportunities, the prices are staying level or slightly going down while the rents are going up. So, I mean, that's a simple equation of to pounce on an opportunity like that. And we found in San Francisco, and I'm sure in the markets that are here, the Nashvilles, the Oaklands, those rents nationwide are staying at all-time highs. So great for investment.
Yeah, and we'll talk more about that too in a minute.
Yeah, and I apologize for the formatting, but I'm sure we'll get through it. So this is with all the conditions and analysis that we just went through on some of those key data points. I think this is what's most interesting to me. Having somebody on the lending side and then on the realtor side with the Bellings brothers is what does this mean to you guys in terms of predictions for what's next for the housing market, and what kind of knowledge or advice can you give to us on the buying side?
Yeah, and sorry, Josh, it looks like I stole your thunder there on bullet point 1, but go ahead if you want to start with yours. Aaron, go ahead. You want to talk about today's landscape?
Sure. Yeah, we basically, part of what Michael and I always talk to our buyers about and implore with our people is that you only really know what's happening today. And tomorrow is always going to go one of 2 ways, right? It's either the market's going to get a little bit better, the market's going to get a little bit worse. And we'll kind of talk about the nuances there in a sec. But Michael and I are huge advocates of something that we've created called the 3 Fs. And that's whether it's a good time for your family, your future, and your finances. As long as you can check those 3 boxes, you should never be trying to time the market. You should never be trying to do anything fancy. It's like, it's the right time for my family because we need more space. It's the right time for my future because I'm tired of living in this tiny apartment and I want to be there for the next 10 years. And it's the right time for my finances because I can afford these monthly payments. Whether the housing market goes up or it goes down, I can still pay my mortgage. You can check all 3 of those boxes. There's never a bad time to buy. And what we're talking about today in today's landscape is a shifting market. So we have all of these buyers. So Michael and I have all these buyers, and as soon as things start shifting, they start going to the sidelines. And I'm going, what's going on? Everyone's nervous about jumping in, the stock market, things like this. It's like, guys, this is what we've been waiting for. This is the opportunity where you're not competing with 30 other people for the same house. I wrote an offer in a neighborhood here in San Francisco called the Sunset last week. There were 3 offers, like same house, not identical, but like very, very similar house. I wrote an offer in February, 29 offers. It's like finally an opportunity. And if you can afford, like I said, you check in those 3 boxes and you can afford to buy today, do it. Because if the market gets better tomorrow, you're the smartest guy in the room. And if the market gets worse tomorrow, the interest rates start going down a little bit, you just refi and then you can lock in that lower rate and you bought at the lower price already. So it's really just about buying at the time that's right for you and your family and your friends and your future, like all the Fs.
Yeah. Also, you won't know when the bottom is until it's too late. So until 6 months later. So that example Aaron talked about, even if the values go down a little bit tomorrow, you're owning this investment or primary residence through time, and it's going to go up over time. But what I'm trying to preach to people right now, and my prediction for the market is what I'm calling just a market normalization. You turn on the news, you read the internet, and everyone thinks the sky is falling everywhere, from stocks to housing to goods to inflation to gas. It's like everything you read is negative news because that's salacious. Sexy news and fear sells. And there's a lot of fear in the media right now. And Aaron and I, we get it. We are in a shifting market, and it's, the train of the last 24 months of double-digit appreciations. Those times are probably over for right now. But you know what?
It's good.
It's good. Because this was an unhealthy market. I mean, for 24 months, we were saying this is unhealthy. It's appreciating too quickly. Anything that goes, we knew this day was coming. And so now it's just leveling off. And my camera's wrong. It's just leveling off now. So instead of the double-digit appreciation gains, you might have modest single-digit appreciation gains, maybe slightly lower or single digits higher, but it's normalizing in a healthy way, and it's a healthy market in that sense.
I heard an analogy the other day, said for the last 2 years, it's like driving on the freeway going 150 miles an hour. You know, when you're making that long trip, like I'm driving to LA, or, you know, in Hawaii, you're driving from one side of the island to the other, you're going really fast, and then you pull off in the exit and you're sitting at that first stoplight and you're like, whoa, everything's like super slow right now. That's where we are. We just exited off of the turnpike. We were going 150 miles an hour, and now we're going 45. And it feels like everything is super slow and everything's shifting and all this. And there are some economic factors to point to that, but it doesn't mean you get out of the car. It just means like you're driving 45 now for a while, and that's okay, because then you're going to get back on the freeway in a few years. Maybe it's a few weeks, maybe it's a few months, maybe it's a few years, but you're still going to get back on the freeway at some point. And you're going to start to see the prices come back, and you want to be in your house before that happens, I would say.
I love that analogy.
Yeah, like they say, right? Don't wait to buy real estate. Buy real estate and wait. Yeah, like, you know, I agree with the forecast. Like the 5% I have there is not from me. It's from like Lawrence Yun, who's the chief economist from the National Association of Realtors. So totally agree with what Aaron was saying. That's what we're going to see. But that's still actually really good appreciation. Like over the next 5 years, they say you might make 25% appreciation, but because you're leveraging, you're only putting like 10% down, 20% down. That's still like 100% return on investment. And another thing that, you know, I want to share too is like, if you even think about back in 2008, right? Yeah, there was a market crash. Today's not going to be like that. It's not like that at all. So we definitely know it's not going to crash. But think about people who bought before 2008 and it crashed, and they held it till today. Are they happy? Like, heck yeah, right? So even with the huge crash, as long as you hold it long term, it still recovers, and prices today are still way higher than like in 2006. So yeah.
Our dad has been investing in San Francisco for 40 years, and he talked about when he moved here in the 60s, and everyone said real estate's too high, rent's too high, you can't get a good job, there's not enough housing, you know, all these negative things he bought every decade. How do you think he's feeling now about the things he bought in San Francisco from the 60s through the 90s? Pretty darn good. So just a real life example of Josh.
Yeah, it's still expensive. There's still not enough housing.
Yeah.
It's the same issues. It's just a different decade. But I think Josh and Michael said it. It's like owning a stock. If you buy a share of Amazon at 3,000 and then it goes down to 2, do you sell it? It's like, no, you hang on to it until it's back at 3 and then you sell it. It's the same thing with owning a house. If it's putting shelter over your head and you can afford to pay your rent or your mortgage, if things shift or things change, no one's going to force you to sell as long as you can pay your mortgage, and that's the key. If you can afford it, it's always a good time to buy and get into a place.
Yeah, I think this is exciting for me personally, because co-buying a house is going to be the first way that I become a homeowner myself, and being, you know, more of a novice in terms of being on the buyer side. This is refreshing to hear, and yeah, it takes away a lot of the anxiety that I get from reading headlines every single day. So this is super valuable to me. So yeah, I really appreciate that kind of like clarity, especially from, like I said, you guys who have been in the real estate industry for a long time.
Michael and I always told the story when we sit down with buyers the first time, because they always say, how are we going to be able to compete? How are we going to be able to afford this? It's a cash game, this and that. And we sit down and we go, 95% of the people we help are putting 25% down and getting a loan. The other 5%, like sold a company, parents are paying for it, you know, whatever it might be. You don't read those headlines, don't exist. You don't open the Wall Street Journal and it reads like cute couple pays asking, buys first home, puts 20% down. It's like that's not what people want to hear about. They want to hear like cash, 2 million over asking, like, you know, foreign money's taken over. It's like that's the stuff you read about, but that's not reality.
Yeah. And on the flip side today, only 2 offers on a property. Oh my God. Not 20.
It's like, this is what you wanted.
Yeah. Just to clarify, Aaron, not 95%, but 25% down. I think you meant like 15 to 20%. Just like,
no, I meant 95% of our buyers are just paying asking, putting 20% down in our first time, like getting a loan. They're not these super rich, all cash. Like, because I was just saying, like, Mark, you're like, everything you read is all doom and gloom, but that's just not the reality. we are shifting, things are changing, but that doesn't mean that it's time to get off to like abandon the search altogether.
Yeah, and it looks like we got one question. I think the recession is very different than others due to oil prices, interest rates, the war in Ukraine, and inflation. Yeah, so this one, I graduated college in 2008, and then 2 months later, the Great Recession hit. So I still have, that was the first real recession of my adult life that I remember. So that one was completely driven by the housing market. And so as like an older millennial being 36, I still have hangover from that 2008 recession, the only one I've truly lived through as an adult. So I think a lot of millennials are in the same spot, and they equate recession to
Global
like a
financial
housing
crisis.
collapse,
Yeah.
right? Yeah, and it's very interconnected with the housing market from that 2008 experience. So yeah, I definitely agree that this recession is very different and caused the factors are caused by way different things.
Completely way different things. And like you look at like the factors that caused the last recession was like horrible lending practices that don't exist anymore, like literally stated income loans. It's like, it's incredible how negligent we used to be around these things, and none of that is in place anymore. I don't have the numbers in front of me, but the number of like mortgages that are underwater right now, I believe, is less than 10%. And then during the Great Recession, it was like 60%. It's like some outrageous number. Unemployment's at like a 40-year low, if I remember correctly. During the time of the Great Recession, it was at like a 40-year high. So it's like some of the key indicators are really not let's put it this way, a correction is not a crash. I heard that this week, and I thought that made a lot of sense.
Yeah, definitely. Especially, and again, one of the first charts that we went over in this conversation, Joshua showed that that 2008 recession was the only recession that had a correlation to the housing market going down, and that one was specifically driven. Like the main cause of that recession was because of housing. Right. That's why it went down.
It's interesting. The recession as soon as COVID started, I think housing is what kept us out of a potential recession. So, or like the recession was like just one quarter, maybe it was half the year. I don't remember what the exact numbers were with the GDP, but housing is what kept us afloat in early 2020. It's really what's driven a lot of the economic, I guess free money too from the government for the last 2 years, but housing's been a big player in keeping things moving in the right direction for the last 2 years. But now we're just overcorrecting.
Yeah. Totally. Okay, so we'll do a little role play right now. I'm considering buying, in Joshua Tree, and as realtors, I know you guys are San Francisco, so maybe we'll just say I'm considering buying in San Francisco. And on the lending side with Josh, if I'm hesitant right now, and I'm like, ooh, I kind of want to wait and see what happens. What are the pros for me? Convince me that right now is a really good time to buy. I know that we went over a lot of this already, but maybe if you could hit me with like a one-liner or two-liner as a potential buyer.
You want me to go first? Okay,
sure.
The biggest thing, Mark, is just how it's so less competitive, like Michael was saying, because I would just say, what do you think would happen as far as the demand if rates drop to 3% like they're forecasting? It'll probably be crazy. We're probably going to be facing 30 offers. So it's going to be a lot harder. So if you find the right property, I would say still buy now, because again, the prices may correct a little bit, but again, it's so hard to time that I think it's just more important, just to at least look. So if you find the right one, still wouldn't be a bad idea to buy.
Yeah, I think you have to really run the math in your area. And I've had many examples from many different lenders like Josh. If you look at today's interest rate and the house price you're getting it for today versus the interest rate in January and February, but the price, the competition that you were facing then, it makes more sense to buy today, or it's right on pace with what it was.
You had low rates, high price. Now the prices are coming down, even the rates are going up. Your monthly payment hasn't changed.
Aaron and I were selling, not to downplay January and February and like people got bad products, but we were selling houses that probably shouldn't have been valued at what they were valued. And everyone in every market for, the best example we have is this house we lost in the Sunset for 1.9. And I helped my buyers get a very similar one last week for 1.7. So you're talking about a $200,000 difference. Now, of course, every example is different. Every neighborhood's different. That's not going to be every product, but you're finally getting that house, that investment, that co-buying opportunity that you couldn't have gotten 6 months ago.
Right.
And the money is a little bit more expensive, but you really need to look at the historical interest rates and understand you're still getting a very good interest rate. You're welcome to refinance in 12 to 24 months if they go down, and you are getting that house and that investment without competing with a bunch of other people. And you're paying the value of what it should be. I think some people were panic buying a little bit earlier this year.
Oh,
and now
1000%.
people don't have to panic buy.
Right. It's not that people may, we don't like the term overpaid because it's a free market. When you get 30 offers, it sells for what it's supposed to. But people were paying more than they probably should have 6 months ago for the same home. But it's all ends up being a wash because as prices get compressed a little bit, as rates go up, it ends up being the same thing. The pros to buying right now are it's the best time to buy it, and it's been the last 2 years. I mean, I have some buyers who have literally been trying to buy for the last 2 years that are now finally able to do so. So it's a good thing for a lot of folks as well. It doesn't another pro like we have right down here. It's like, it doesn't change the fact that rental prices are going up still. It doesn't change the fact that there's still 1,000 benefits of home ownership. You're going to be able to build equity in your place. The tax benefits alone are worth it. We'll mention on the next slide too about rent versus buy. But it's like, it doesn't change the fact that if you have a let's call it $3,000 a month rental payment over the next 3 years, it's $100,000 you're never getting back, 118,000 or 108,000, something like that you're never going to see again. So take that 108,000 that you're going to pay in rent over the next 3 years and just put that as a down payment on a house up front instead, and you're going to be glad you did 3 years from now.
Yeah.
Yeah. I was going to say, I'm curious if Megan's still in the chat. We know she's over in Oakland. And that's close to home here in San Francisco. So, I feel like the pros and cons and predictions, especially with the Bay Area in mind. I'm curious, Megan, if you're in the chat, if you can let us know if you're planning on buying in the Bay Area or outside of the Bay Area. I'd be curious.
Well, in Oakland, rental prices have gone crazy too. I think it might be it's almost more expensive to live in Oakland than the city now. Did we want to talk about some of the cons, Mark, or should we just move on?
I think we covered the cons kind of like in prior, unless there's a specific con that you want to call out.
Good.
And our favorite thing when talking about rising interest rates, which you can see on this slide, is the interest rate when you rent is 100%. So you're always beating that, even with rising interest rates. Aaron and I co-bought our first property together about a decade ago, and you know what? It was the most expensive property at the time, and people said we were crazy and blah blah blah.
And it was we spent all of our money, like 75% of our savings was wiped out.
Yeah,
and it's probably worth twice what we paid for it 10 years ago.
Yeah, and it was a nice 3-bedroom in Cole Valley, and we've seen what Cole Valley has done. And we don't say this to like gloat or brag, but it's like we spent every dollar we had to try to make it happen, even though the market was crazy or expensive, because we've been taught that over time, real estate is always worth more.
Well, people told us to wait because the market was really hot, and it never slowed down for another 8 years after that until 6 months ago or 3 months ago. But this slide is really interesting and really important because I think it goes back to not only our 3S, but it also talks about just sort of the mindset you have to have when you're approaching your purchase is, do we have our investor hat on? Or do we have our primary residence hat on? Because the approach to buying an investment property versus a place that you're going to live in can oftentimes be similar, but they can also be very different. So like for investors, for example, like one of the things I wanted to highlight is what goals are we trying to accomplish? And that leads me into, is this a short-term return play or is this a long-term appreciation? Because like some markets, like San Francisco, you can maybe break even on a good rental property, something like that. You get lucky, you get like a small cash flow, but I don't call San Francisco a short-term return market. San Francisco is the one where you buy a multi-unit building, you put somebody in it that's going to hopefully cover the rent, and then you look up 20 years from now and you've made $2 million. That's not going to be the same for Joshua Tree. Joshua Tree might be able to kill it on short-term rentals, but that $600,000 house probably isn't going to be worth 2.6 in 10 years. I mean, I don't know, but like just generally speaking, you have to figure out what approach you're going to take as an investor and figure out and really figure it out into what's happening right now and how you can best capitalize on that.
Yeah, and going a little bit further on the investment piece, I think it's really important to stay the course. work with your co-buying partners, recalibrate your goals, whether it's short-term rental cash flow or long-term appreciation like Aaron's talking about, and recalculate your overhead costs, because nothing should be any different. If you have a great realtor on your team, you should understand the price of that property. You have a great lender like Josh, you should understand your interest rate that you're paying with an investment. You should understand, energy costs have gone up a little bit, but you should understand your electric and energy bill, and rents are remaining high, and you know what the rental prices are. So if you calibrate all this and analyze your investment and how much cost versus how much income you have coming in, a down market should be a much better opportunity for you, because you're getting that property at a lower acquisition price, and the rent's still staying high. So just recalibrate your costs and your income, but those should all be somewhat fixed, or you should have a really good range of that if you have a good team on your side.
And the good news about owning investment property in a shifting market is that if the price of the building goes down, the rents typically go up. So it's again, owning that Amazon stock, maybe the price of that building's gone down a little bit, but maybe your monthly has increased as a result too. And then the primary residence piece, obviously, I think speaks for itself, but we can always answer questions individually too.
Yeah, I just want to be cognizant of time.
Definitely.
If you guys do have questions for any of us, put them in the chat now if you'd like to. I'll be sharing the Bellings brothers and Joshua's contact info, so you can follow up with them. I know maybe Bellings brothers, I know you guys specialize in San Francisco, but I know that you also have great referral realtors that you've helped our co-buy groups out with. So even if you're not looking specifically in San Francisco, these guys have hooked our co-buy groups up with awesome realtors that our groups have loved. And Josh also has hooked up our groups in a variety of different markets with lending options too.
Yeah, we've got our minions everywhere. So if you're looking, like Megan, you're looking in Oakland or Berkeley, we've got like 2 fantastic teams out there. Always feel free to reach out to us. We're always happy to share those names. And if you're working with Nestman, then they're most likely already a Nestman approved realtor as well.
Yeah. Well, thank you guys so much. And for people attending, like I said, I'll follow up with a recording of this, our lovely presenters' contact info. And if you guys would like to receive content from them, I know that their teams put out content as well. I read it all the time, and it's super helpful for me being more of a novice first-time home buyer. It's super informational, super helpful. So I really appreciate you guys doing another conversation. And yeah, have a good rest of your day. And yeah, really got a lot out of this conversation.
Thanks, everyone.
Awesome.
Wonderful day.
Thanks, everyone.
Bye, everyone. Have a good rest of your week.
Awesome. Thanks, guys. Have a good day.
See you next
Bye,
time.
everyone.